New highs today, but my next guest says systemic risk may be back on the horizon. Joining us now, Chris Whalen from Kroll Bond Rating Agency. And you're talking about a liquidity crisis.
Yeah, we put out a note this week that talks about the regulatory changes, low interest rates, and how this affected liquidity for investors. The Fed, as some of you may know already, has already told the big buy-side shops that if we have a crisis next time around, they're not going to let them run for the door. They're going to expect to have them sit and hold on to those securities. And the other ironic thing, of course, is that street firms, they don't make any money on carry anymore. They don't make any money on clearing balances. So there's no meat left on the bone to justify them making markets, especially in things like treasuries and agencies. There's no capital there. So the buy side is kind of won in a sense. They have the resources, they have the liquidity, but nobody's going to make them a price. If you go back to 2008, in fact, a lot of the bigger hedge funds were, in fact, providing liquidity to the market during the worst days. But I think what's going to happen next time is you're just not going to be able to run for the door. The door will be shut.
You guys agree?
Well, I mean, I definitely agree that you obviously have the capacity for more air pockets, a lot more jagged trading when this all happens. But I think the other side of it, haven't we spent the past few years reducing hedge fund leverage in the prime brokerage channel, more capital at banks, even if they're not dealing that much?
Yeah.
So, in other words, is the aggregate risk still as in large?
Well, here's the irony. Look at the mortgage market. The increase in capital for firms that are in the Fannie, Freddie, and Ginnie market has actually reduced their profitability, reduced their liquidity, and you have less turnover in the secondary market. Secondary markets down dramatically.
You have less turnover everywhere, actually. You have less turnover in the equity markets. You have less people willing to extend credit.
Right.
And I think, too, that, more and more, because of this artificial environment with interest rates, you've got more risk on the table.
Well, precisely. I mean, think of it from a trader's perspective. The Fed's been taking duration out of the market for years. Now they want people to be willing to come in and take risk and make markets when we're at the extreme end of the curve. No. I think, if anything, people know that Merton model or the Black-Scholes model doesn't work when the interest rates are near zero.
But I think we talk about, you mentioned mortgage market. If you look back in 2008, we had so much liquidity. Just in general, there was so much money floating around, which was part of the problem. So we went from one extreme to the other. And I like that you mentioned Black-Scholes. People trying to use these models, and I know in your note you said when the numbers get to zero, basically, then the math doesn't work. Right. But is it almost maybe a good thing that if we know the model doesn't work, then let's not try to use it, because we used so many models in 08, and that's why we blew up. So is it better not to trust it?
I agree, but in the real world, for example, the mortgage market, when people have to hedge in the TBA to have enough cash to close the mortgages every month. Remember Ben Bernanke's press conference, the taper tantrum? They got annihilated in the TBA market. That market
is that a learning lesson, though? So now there won't be a taper tantrum again because we had it a couple of years ago,
no, it means
and people are ready for
it. They need to have the cash, and they can't hedge effectively because they don't know what the hedge ratio is.
But what happens in a liquidity crisis a lot of times, and we saw this with long-term capital, is the whole street all of a sudden knows what's exposed, right? So the liquidity comes right out of the market because everybody knows to step away from the keyboard, so to speak. That happened with Lehman Brothers in 2008. Everybody knew where they were, so everyone pulled out of the market at the same exact time. So a lot of times in a liquidity crisis, it's because, it's out loud all of a sudden.
Sure. Suddenly,
right.
Mike, last word.
I was just going to say, do we see any leading indicators of a catalyst? I mean, is the Fed hiking in itself going to raise that transaction tax just enough to make the difference?
Briefly?
I don't think they can hike. They can raise the rate they pay on bank reserves, but Fed funds, no. Look at how many bidders there were for the last auction. Just not going to happen.
Well, there are plenty of voices drawing attention to this issue. You're one of them, Chris. Thanks for being here. Appreciate it. From Kroll Bond Rating Agency this afternoon for us. Coming up, after we take a short break, we're going to talk about 40 million Americans holding more than $1 trillion in total student loan debt. And those loans aren't serviced by the lenders, but by processing companies charging a flat monthly fee per account. Now, a consumer watchdog opening an inquiry on concerns those companies are doing as little as possible to help customers pay back debt. We'll hear from the CFPB next. And speaking of millions of dollars, fewer robberies. Fewer robbers bursting into banks and cleaning out cash drawers. That's because cybercrime is becoming the preferred criminal method. Bank stick-ups aren't what they used to be. We'll have that story later on The Closing Bell.